Welcome back. The banks and ASIC are currently in a bit of a battle, just as the banks are copying it on the stock market. So what is the outlook for dividends in this unsettled environment? Tony Featherstone is the former managing editor of BRW and Shares magazine, and nowadays is a star contributor with the Switzer Super Report. He joins us from our Melbourne studio. Hi, Tony.
Hi, Pete.
I've been dying to get you on TV for ages, mate, so it's a great treat for me to see you there.
Thank you.
Let's talk about the banks and dividends. What do you think is the outlook for them?
Well, I think dividends in general, if you go back to the latest profit reporting season, which finished at the end of February, wasn't too bad on the dividend front. We had a record number of ASX 200 companies reported a profit. We had more companies paying a dividend. We had about 2/3 of companies that reported increasing their dividend, and dividend per share growth was about 7%. So it actually wasn't that bad. But of course, you can't look at headline yield of the past. You've got to look forward with dividends, and that's the mistake people make. And I've got to tell you, Pete, it's getting pretty tough on the dividend front. So if you look at the trends in the reporting season, negligible revenue growth collectively, so companies are struggling to grow their revenue. That will put pressure on earnings, which puts pressure on dividends. Companies in their guidance statement, so their outlook for the next 6 months, were more cautious, and analysts were downgrading earnings. Now, at the same time, you have record high dividend payout ratios. So if you were to wrap all that up, you'd say companies are working really hard to pay dividends because they know investors need dividends, they want dividends, and they'll pay more for dividends. But it's getting harder. It's really getting harder on the dividend front. And my gut feel is companies will be doing well to maintain their dividends collectively in the next 6 months. And I think if they do, we'll probably see lower dividend per share growth.
Okay, that's interesting, because I think a lot of people would be happy if the yield is maintained. If it was cut like BHP's, I think there'd be a hue and outcry. But let's focus on ANZ, because that's obviously the bank that's under pressure. Can you see them cutting their dividend or simply maintaining it?
Look, I think of the 4 big banks, ANZ is the best value, but it also has the highest risk, and I think they're most at risk of cutting their dividend. Certainly they have more exposure to the resources sector, there's more uncertainty about that bank, there's been more problems. So of the 4, I think the odds are the highest that ANZ could cut its dividend.
Okay, so that's the dividend side of it. Let's go and look at the potential for capital growth, and there's this battle with ASIC, and I'd love to know what you think the view might be. Let's take, for example, Westpac. Do you think Westpac's share price will be materially affected by this potential battle with ASIC over, the setting of interest rates in the professional market?
No, perhaps at the margin. I don't think it really will be. I mean, there's bigger issues to me for the banks, and that's their capital requirements. There's concerns about the housing market, so there's a lot of headwinds for the banks. Now, that's not to downplay the significance of this alleged rate rigging, but I think it's one of a number of headwinds facing the banks. I don't think it's the biggest, but it is an issue for Westpac, but I think it'll get through it.
Okay, well, you've stolen my next question, because there are a lot of whisperings, even louder than whisperings, that APRA could actually ask the banks to, get more capital, and that won't be good for the share price if that's the case. What's your view?
Look, it won't be, because more capital means that will weigh on return on equity, won't it? If you're holding more cash and you have to have that on your balance sheet, more capital on your balance sheet, that affects return on equity, which affects the share price. So that's a big problem for the banks. And it's a big concern, and if those capital requirements go up, then that's something to watch with the banks. So as I said, I can't recall since the 2008 GFC the banking sector having more things coming at it than now. It's not just the capital, it's ASIC talking about policing corporate culture in the banks, it's the fintech companies coming after the banks, it's all this ridiculous gloom and doom overseas that Australian house prices are going to crash by 40%, which is ridiculous. But boy, the banks have some problems, and so I can understand the regulators wanting to increase capital requirements. I'm not sure they need to go as far as they have, but it's a concern for the banks.
Well, you've made some great calls for the Switzer Super Report over the last couple of years, and if you hadn't made great calls, I would have told you you've made hopeless calls, but you made some great ones. You made some great. But the bottom line is, Tony, do you think banks have value at these levels? If for the long-term investor who's happy to wait 3-5 years and accept even current dividend levels, do you think they're good buys, or do you think they're reasonably risky buys?
I think they're good buys, Pete. I wouldn't say they're exceptional buying right now, and it varies, but I think they are good buying for investors with the time frame you just outlined, 3 to 5 years. Having said that, I think there's going to be more volatility in the next 12 months in bank share prices because of all these headwinds I've outlined. But they are good buying. I mean, some of the yields are getting around 10% fully franked, and perhaps that's the market's way of telling us that those dividends, I beg your pardon, aren't sustainable.
Yeah.
I think for most of the big banks they are. And my preference for the big banks, Commonwealth Bank first, Westpac second. NAB I think looks pretty interesting. Now that they've offloaded Clydesdale, I think a slimmed down, refocused NAB seems to have a lot more momentum. That's looking a lot better. ANZ, more risk. If you want to take more risk, go for that one. But to answer your question, yes, they do look. They look pretty good value to me.
Okay, and away from the banks, what other sector do you like most?
Look, I like infrastructure, and to me that's stocks like Sydney Airport, Transurban, and the utilities like the Telstras and so on. But I'm a big fan of the infrastructure stocks. I would have to say Sydney Airport's probably been my preferred stock over the past 5 years, and I've written about it a lot, and every time I write about it I get people saying too much debt, hard to understand, richly valued, complex and so on, and yet it's kept going up and it's defied the critics. And I like Sydney Airport. Look, I'll be the first to say it's not cheap, but I like Sydney Airport for a few reasons. One is when I look for dividend paying stocks, I want stocks with real economic moats, and that's a fancy way of saying what is it about this asset that will defend this company's earnings in good and bad markets. We want stocks that do well on the up and on the way down. Now, it's hard to avoid Sydney Airport, isn't it, if you're coming overseas to Australia? So to me, that's just a fabulous monopoly asset. And the other thing I like about it, Pete, you'll know from my columns in the Switzer Super Report that I'm a big believer in finding companies exposed to what I call these investment megatrends that take years or sometimes even decades to unfold. Now, I've really been following this middle-class consumption boom in Asia. And if you believe the OECD forecast, doesn't have the best track record of forecasting, I might say, but it's saying that roughly another 2 billion Asians will join the middle class by 2030. And to me, even if they're half right, that is just the mother of all trends. And that is such a tailwind for our tourism sector. It's such a tailwind for Sydney Airport. You look at its traffic statistics, international passengers up 10%. I mean, how many other Australian businesses have 10% growth in their customer numbers year after year? So I still like Sydney Airport. I like Transurban, the toll road operator. Toll roads are a funny business. They're fantastic when people are willing to travel on them and pay the tolls. They're shocking businesses when people avoid them, as we've seen with some of those Queensland toll roads over the years. But, you know, on the way to this interview, Pete, I took a Transurban toll road in Melbourne. When I go to the airport later this month, I'll take a Transurban toll road. And again, so it's got that economic moat, but again, getting back to that theme of tailwinds, which I spoke about earlier, I'm a great believer in this trend of city densification. I don't think people realise how crowded, congested our capital cities are going to become, particularly Sydney and Melbourne over the next few decades. Sadly, I might say, but that's the reality, more traffic congestion. And that could ease once these self-driving cars arrive, but that's still, you know, a long, long way away. And I think the reality is more cars on roads. Transurban has good scope to widen the roads. It's doing that in Melbourne. I think it'll get more concessions and extensions from governments because governments are cash-strapped. They can't agree on infrastructure. When they do, they go and pork barrel it and put it in places we don't need. So I think Transurban's a pretty good one.
Tony, thanks very much for your observations.
You're welcome.
To read Tony's full articles on many of these areas, you can go to switzersuperreport.com.au. You have to register for a free trial access, but given some of the observations he's made, I think it's really worth it.